Hello friends, welcome to Insights ICANN initiative. In today's video, we are going to discuss about monetary policy review. Recently, RBI's monetary policy review decisions have been announced, and the monetary policy committee they did not change the policy rates that much. In this context, we are going to discuss about what is this monetary policy committee and what are these changes and interest rates and all these things we are going to discuss. Now, let us go through the syllabus mapping first, then we'll go through the video contents. It is related to General Studies paper 3. In GS paper 3, you have banking sector, monetary policy, growth and development. These three words are related to the monetary policy. In fact, we are going to discuss about this monetary policy which are irrelevant to these three areas. In this video, we are going to much focus on the areas such as why it is in news. It is in news because RBI's monetary policy committee review, the decisions have been announced. What is this monetary policy? And the classification of monetary policy. Monetary policy can be classified into two ways. One type of monetary policy will expand the money supply, and the other type of the monetary policy will contract the money supply. That means reduce the money supply in the market. Then what is the monetary policy committee? Whether it is a statutory body or the executive body, how many members, how the voting will be there, through which act this monetary policy committee was enacted. We will discuss that. Then what are the instruments of monetary policy? Monetary policy can be executed through two types of instruments such as qualitative and quantitative. So in this video we are going to give much emphasis on the quantitative tools. We will discuss about that. Then finally, so what are the recent decisions, like a few days back, what are the decisions taken by the monetary policy committee? Those decisions we are going to discuss. So these are the areas we are going to much focus in today's video. First, let us explain some basics regarding this monetary policy. First, you should remember, students, that is, in market, price of a product is always determined by its demand for the goods as well as its supply for the goods. The supply of the goods generally regulated by fiscal policy. Fiscal policy. So fiscal policy always operates on the supply side, whereas the demand in the economy regulated by monetary policy. Monetary policy. So monetary policy always operates on the demand side of the economy. Generally, fiscal policy determined by the government of the particular day. Government decides the fiscal policy through budgets, whereas the monetary policy, it will be reviewed by RBI. RBI reviews. So RBI reviews monetary policy through a committee known as Monetary Policy Committee. Monetary Policy Committee. And this monetary policy committee composition and their objective and what are the recent decisions taken by monetary policy committee, we will see. Then you have to know how the demand will be regulated. Demand will be regulated by monetary policy committee in two ways: by using qualitative tools and quantitative tools. Quantitative tools. These are the two ways money supply or money demand side can be controlled. In this flow chart, you can see such as qualitative tools and quantitative tools. Qualitative tools, example, margin requirement. That means RBI may give directions to banks to increase the margin money, so that a person before getting their loan, they have to deposit high amount of the money, then only they can avail the loan facility. In the same way, selective credit control and moral suasion. So these are some of the qualitative tools. With respect to quantitative tools, direct tools and indirect tools. Direct tools, CRR, it is the percentage of cash in the cash form, liquid form. Okay, cash, percentage of cash the bank has to maintain with the RBI. For example, entire banks, like assets and liabilities are 100, for example. Banks, so time as well as the demand liabilities are 100. Out of that 100, you have to maintain a certain amount of the money with RBI. So CRR is all about percentage of the money the bank has to maintain with RBI. So CRR always with RBI. Next, SLR. Out of the bank's entire deposits, certain percentage of that bank has to maintain either in the form of the money or in the form of the gold or in the form of the government securities. It stays with the bank only. SLR. So these are the two very frequently used tools in terms of the direct quantitative tools. Indirect one, repo rate. It is the one the RBI charge the rate of interest on banks. When banks need money, they take money from RBI. In that process, RBI will charge certain rate of interest on banks, that is known as repo rate, reverse repo rate. If banks are having money, they'll park their money with RBI. In return, banks will get rate of interest, that is known as reverse repo rate. So in the repo rate, bank has to pay. In reverse repo rate, bank will get the rate of interest. That is the basic difference. And rest of the things we will discuss as the video is going on. So through these tools, RBI will regulate the monetary policy. Remember, RBI always focus on the demand side of the economy by reviewing the economy for every 2 months. That is known as bi-monthly monetary policy. This bi-monthly monetary policy will be done by MPC, Monetary Policy Committee. The major difference between the fiscal policy and monetary policy, you can see on this slide. This fiscal policy is much controlled by Government of India through FRBM Act as well as through GST norms and all these things. Whereas the monetary policy regulated by RBI in terms of the monetary policy review. And this fiscal policy, it is more towards the government. Monetary policy mainly through RBI. This is the executive, that is Ministry of Finance will prepare fiscal policy. Whereas monetary policy prepared by RBI. And what are the tools we use in the fiscal policy? We use such as budget and minimum support price, certain government decisions. All these are the tools we use generally in the fiscal policy. Whereas in terms of monetary policy, we use tools such as repo rate, reverse repo rate, open market operations. These are the ones we use on the monetary policy side. So these are the core difference between the fiscal policy and monetary policy. Now let us see the notes. Reserve Bank of India's recently monetary policy committee meeting was held and they did not change any rates. That means the repo rate, reverse repo rate, CRR, these rates were unchanged. Now let's see further news regarding this. First, what is monetary policy? Monetary policy is all about controlling the money supply. If the money supply is higher than required, then obviously money will be more and the goods are less. So more money will chase less number of the goods. That means price will increase. Inflation. In this model, for example, let's see. In this model, when the demand is constant, obviously supply is inversely proportional to price. If supply increases, price will drop. If supply reduces, price will increase. This you have to understand. In case supply is constant, keep supply is constant, then more demand will increase the price. Less demand, less price. This is the one you have to understand. Here, when money supply is increasing or decreasing, here we are discussing about when demand is constant, when money supply increase, then obviously price will also increase. In terms of what? Because when money supply is increasing means obviously more demand. More demand means obviously more price. That you have to understand. Okay. So what I am trying to tell, money supply, when people are having much money, then their demand for more goods, demand increases. But the supply is not matching up with the demand, so obviously the price will increase. That means inflation will rise. Inflation will come. In India, inflation will be measured in two ways, CPI as well as WPI. Out of these two, which one we will take into consideration when RBI is deciding the monetary policy? Tell me. Okay, keep your answer in comment section. Let's see which one will take into consideration by RBI when they are deciding the monetary policy. Tell me, students. So this is about money supply. So if the higher the inflation, if the inflation is increasing, then what is the problem? The problem is the people purchasing power will reduce. People purchasing power will decline. That is the problem. To avoid that, this money supply will be regulated by RBI. Money supply will be regulated by RBI so that these kind of negative consequences can be stopped. Now let's see. Macroeconomic policy. It controls the money supply and interest rate. Who decides this monetary policy? RBI decides the monetary policy. Specifically, the monetary policy committee will decide. It deals with the demand side of the economy. What kind of tools used by RBI in this monetary policy? Tools such as open market operations, bank rates, reserve system such as CRR, SLR, and certain other qualitative tools. Now, let's see. If the economy needs more money, that means if the economy needs supply of the money, then what the RBI will do? RBI will increase the money supply through various quantitative tools. For example, now if RBI reduced the repo rate, let's see, reduce the repo rate, that means banks will get the money at less rate of interest. That means funds available with the banks, funds with banks will increase. When funds with banks are increasing, then obviously loans will increase. When loans are increasing, this leads to more investment, obviously, more investments. It leads to more employment. This is how, when economy is in recession, you can spur up the economy in this way. So when money supply is less, this is the way the RBI will do. That means RBI will increase the money availability. That policy is known as, what is that policy? Expansionary policy. But if the money supply is going beyond certain limit, then what will happen? The inflation will result. In that time, RBI will reduce the money supply in the economy. That is known as contractory policy. So, in one way you are increasing the money supply, in the other situation you are decreasing the money supply based on the market condition. Are we clear? So this is the one you have to know, students. Next, Monetary Policy Committee. Its history we will see. Reserve Bank of India in 1934, this act was made. It was amended recently in 2016 for accommodating the Monetary Policy Committee. The Monetary Policy Committee is appointed by Government of India under the section 45 ZB according to the RBI Act 1934. So Monetary Policy Committee came into existence through an act. That means obviously it is a statutory body. What is the main objective of Monetary Policy Committee? It will fix the benchmark interest rates so that it will control the inflation. Normally there is a mandate to MPC to control the interest rate. The mandate is the inflation should be in the range of plus or minus 2 or 4%. That means obviously 2% to 6%. This is the window in which the Monetary Policy Committee will maneuver the rate of interest. 4% plus or minus 2. Meetings generally 4 times in a year they will meet. The quorum for the meeting is about at least 4 members have to come. Voting, each member will have 1 vote. In case there is an equal vote or tie, then obviously whoever the chairman of the Monetary Policy Committee, the chairman will have a casting vote. Same like how we discussed in the Lok Sabha Speaker and Rajya Sabha Chairman, where the presiding officer can exercise the casting vote. Here also the chairman of the Monetary Policy Committee can exercise the casting vote. Now let's see the composition of Monetary Policy Committee. Monetary Policy Committee consists of 6 members. Out of that, 3 come from the RBI and 3 will be nominated by the Government of India. And RBI governor, whoever it may be, he acts as the chairman of the MPC. That means RBI governor acts as the ex officio chairman of the Monetary Policy Committee. Same like Vice President of India act as a chairman of Rajya Sabha. Prime Minister act as chairman of Niti Aayog, like that. Because of one position, you are getting another position. That is known as ex officio. Now let's see some of the instruments used by RBI. First one is Liquid Adjustment Facility, LAF. This is about when banks need money, it will take loans from RBI. When bank is having excessive surplus, they will give the money to RBI. That is known as Liquid Adjustment Facility. They borrow the money, or as well as they will give the loans to RBI. That means it includes both repo rate as well as reverse repo rate. Repo rate, the rate of interest charged by RBI on banks when banks are lending money from the borrowing money from the RBI. Reverse repo rate, the money which will be given by RBI to banks when banks are lending their money to RBI. So that is the reverse repo rate. Statutory liquidity ratio, certain percentage of the money of the bank, it has to be in the form of cash, government securities as well as the gold. That is known as statutory liquidity ratio. Marginal standing facility, it is a penalty on banks, on the overnight borrowings. When their SLR, when they are unable to maintain the SLR rate, To maintain the SLR rate, they have to borrow money from other banks, and in that condition, the penalty rate imposed on that particular bank is about the marginal standing facility. Bank rates. When bank is unable to maintain its cash reserve ratio, then bank has to borrow the money and certain at penalty rates. The penalty rate is about the bank rates. Okay. Next, cash reserve ratio. Percentage of cash in the form of the liquid, that means liquid cash, not gold, not government securities. The percentage of cash bank has to maintain with RBI, that is known as CRR. Open market operation. Open market operation is about banks, RBI as well as government securities. For example, RBI selling the government securities, government bonds selling. These government's bonds will purchased by people. When people purchasing the government securities, that means money will go to where? Money will go to RBI. People are getting the bonds and money will go to RBI. That means this reduces the money supply in the market. Money supply in the market is reduced. So when money supply, it is the reduction of money supply is the outcome. For that, RBI will sell the bonds. If RBI want to increase the money supply, they'll buy back the bonds so that people will get the money and RBI will get its bonds back. So this operation is known as open market operation, OMO. I hope you understood. Then recent decisions of the MPC. MPC did not change any rates. Now CRR is at 4.5% and the incremental CRR 10%. Incremental CRR is a temporary. After demonetization, RBI came up with this proposal that normal CRR is 4%. Incremental CRR is RBI will tell to the banks that, okay, for example, from 1st August to 15th August, how much money you have. You have, for example, 1,000 crores. Out of that, 40%, around 400 crores, keep with that RBI. That is the incremental CRR. Incremental CRR is a temporary, whereas actual CRR is a permanent one. Incremental CRR is only because of this demonetization. When demonetization has happened, lot of people deposit their money with the banks. So banks are overflown with the money. So how to tackle that money? Certain percentage of that money has to kept with RBI temporarily. Temporarily, how much money banks have to kept with RBI, that is about the incremental CRR. Now the incremental CRR is 10%. 10%. Next. So it is to withdraw whatever the excess amount of the liquid banks are having. For that, this incremental CRR we are using. Then inflation. What RBI is saying that RBI is thinking that the inflation in future may increase because of rising vegetable prices and the international food prices are going up, as well as the projections of El Nino is also there. Because of that, the rainfall is also going to be less. So because of these things, RBI is projecting that inflation may go up. In terms of GDP, RBI is projecting that the GDP growth rate will be 6.5%. And like I said earlier, it is projecting that increased inflation. Previously it projected 5.1%. Now it is the 5.4%. 5.4%. Then RBI is also mentioned that RBI is going to encourage the conversational payment on UPI. What is a conversational payment? That means if you want to make a UPI payment, you can make a conversation with artificial intelligence bot, AI powered system. Initially, the conversation can be facilitated in Hindi and English. Later, further languages will be added. That is about the conversational payment they recently announced. They also recently in this meeting, they also announced that they are going to enhance this near field communication, NFC. You know that you can tap your debit cards on the point of sale, that debit card machine through, so you can make the transaction, that is through NFC. So they are going to develop this NFC into other area of transactions. So you can expect some updates in the future regarding the NFC. And RBI also increased the transaction limit from 200 to 500 regarding the small value digital payments in offline mode, including National Common Mobility Card. So on these services, the minimum transaction limit is increased from 200 to 500. So these are some of the details regarding the RBI's Monetary Policy Committee. Now let's see yesterday's video question. The term Swati Mountains, sometimes in news, they are related to weapon locating radar. Next, Pushp portal, which was recently seen in news, is launched by who launched? Ministry of Power. Next, consider the following statement regarding the economic community of West African states. Regarding this, statement 1 is right. It was established through Lagos Treaty. Niger is not a member of this organization. No, Niger is a member of this organization. So only first statement is right. Now let's see today's video MCQ. Quantitative easing is the common name for what? Go through these 4 statements and put your answer in comment section. Mains question. What is the significance of Monetary Policy Committee and how does its decision making impact a country's economy? How does MPC will impact the country's economy? What are the challenges MPC is facing role? And what kind of strategies they can use for the effective management of the country's economy? This is about the mains question. As we reaching to the end of this video, let's summarize what we discussed in this video. In this video, we mainly discussed about some of the decisions made by the Monetary Policy Committee. We also discussed about the various tools used by RBI to control the money supply, such as qualitative as well as quantitative. And we also discussed about open market operation and how they will apply. And we have seen how the money supply increase and decrease, how it affects the people purchasing power. And we also seen about Monetary Policy Committee, its composition and its function, and the voting, procedure of the Monetary Policy Committee. Apart from that, we discussed about some of the quantitative tools used by the RBI very frequently. This is about the detailed analysis regarding the MPC and its MPC latest decisions.